Non-QM loans are not just alternatives, they're better fits for self-employed borrowers. As an entrepreneur, if you've ever been turned down by a bank, you weren't unqualified, you just needed a different tool. By not understanding these loan types, you will miss out on the home you want, overpaying rates, and lose valuable time with the wrong lender. I'm Andrew Russell, owner and founder of RCG Mortgage, three-peat winner of NAMBY Broker of the Year, top originating team across the country, and I specialize in working with entrepreneurs, business owners, investors, and getting them a right mortgage in the non-QM space. I just had the most amazing week, and no, the Jets did not win the Super Bowl yet. I actually had a hat trick of a week. So obviously a hat trick is when you score 3 goals in hockey. So I had three separate clients referred to me that were declined by their, big bank, we'll call it, by the bank that they actually have their monies with, their checking and savings. And I was able to save the day for all three. Three clients, again, all different clients. The first one was a self-employed business owner. The second one was an investor. And the third was a 1099 contractor. So what did I do? How did I save the day? On the first, self-employed business owner, the big bank asked for 2, actually I think even 3 years for whatever reason, super strange, of their tax returns, P&Ls, balance sheets, dissertation papers on what they were looking to do, what they do for a living, why they're looking to purchase, all this crazy stuff. And they didn't qualify. Why? Because they wrote off all their expenses. So the net profit they showed to the IRS, even though it's allowed, all the write-offs were legal and acceptable to the IRS tax code, the net profit wasn't high enough to have them qualify for a purchase. Easy peasy, lemon squeezy. Yes, I have 2 little daughters. I say silly things like that. We got 12 months of their business bank statements. We looked at their revenue coming in, not just their tax returns. We didn't even need the tax returns. So the 12 months, all the revenue, they were 100% owner of that business. We gave them credit for half of it for income. It 100x'd their purchasing power just by putting them in the right program. So easy loan to turn into a non-QM bank statement program, and we'll go into the details of that later. But that was the first client, and that was already a great week, right? Just working with one client and saving the day is good. Now, the second client, they were looking to buy an amazing deal, a 4-unit property in Miami, which is almost unheard of. They were getting it for under market. The seller had to, sell and move, and they just wanted to get rid of it, as soon as possible. And they were getting denied by their big bank. Why? Because the way that their accountant wrote off their other rental properties on their Schedule E, there was a lot of expenses on their tax return. And on paper, to the lender, they actually didn't qualify, which is crazy. There's a seasoned investor putting down 25% or even 30%, and they just didn't qualify. So, of course, again, easy lemon squeezy. We put them into a DSCR loan, right? A DSCR mortgage, non-QM, a 1 to 4 unit property, putting at least 20% down or more. Typically, it goes off of the market rent. We didn't need any of the tax returns. No questions asked. This was a seasoned investor. They were putting down, I think it was at least 25%. And the market rent covered the mortgage. Just like that, they qualified. They're like, I don't understand. Why didn't our big bank offer this? Non-QM loans are typically not offered by the big banking institutions. And again, now I'm 2 for 2, having a great week, crushing it. And the third client comes in, same thing. Was looking to buy a house, got a pre-approval from the big bank, and then started to kind of go sideways once they were in contract, and then got a denial. Why? The loan officer, for whatever reason, calculated that client's income off the 1099 and not off the tax return. So the typical, a conventional mortgage, the way you calculate income when you're a 1099 contractor is that you go off of the Schedule C, typically, and whatever the profit is, that's what you use, not that 1099 number. So that 1099 contractor got $20,000 a month every month. So of course, you get a pay stub or a couple pay stubs that show that in the 1099s, and maybe a loan officer makes a mistake and uses that as the baseline of income, which is wrong. In a conventional mortgage, a 1099 is basically like cash. Pay stubs, you don't ask for them. You just ask for the tax return. So they went off the Schedule C, the actual underwriter at the lender. So again, they were pre-approved, which was wrong. The lender underwriter, when they were in contract, said no bueno. They don't make $20,000 a month. They only, after profit, after expenses, their profit is $4,000 a month. So they got declined, came to us, and we actually had a 1099 program. The non-QM side offers a 1099 program where we can go off 90% of the face value of that 1099. So to keep it simple, $250,000, take 25 off the top, so $225, which is 90% of a $250,000 1099. We use that for the yearly income and divide it by 12 versus looking at their tax return. So this isn't offered by all places. Non-QM loans are definitely the specialty in the non-depository institution space or working with mortgage brokers. But that concluded the three-peat. Had a killer week, 3 clients thought they were a big fat no, and super simple. As you can see, they were just being put in the wrong mortgages, and we put them in the right non-QM, specifically the bank statement, DSCR, and then the 1099 program, and they qualified. Super easy, lemon squeezy. And the haters are always hating, and what are they saying? Andrew, this sounds so cringe. Are these mortgages even real, even viable? Yes, just because of the last several years, conventional loans, Fannie, Freddie, FHA, VA, USDA, portfolio, HELOC, these are just the most common in the household. Non-QM has definitely taken the mortgage space by storm, and a mortgage is a mortgage, right? It's just the way they look at income and qualifications is different, but it's still, there's nothing shady or different about it. It's just the most popular mortgage right now on the upswing. More and more of these are being done, and just because something is new doesn't mean that something is bad. And of course, the biggest thing, Andrew, the rates are probably so much higher. That's not the case. We've seen over the last year that in the non-QM side on the primary purchase, using bank statements, some of the programs we're about to talk about, the interest rate offering is actually the same. That's right, the same. Typically the best scenario, 2 teachers, teachers usually make the easiest income to figure out. So 2 teachers putting 25% down with 740 credit scores. That's usually like our avatar of the best case pricing for a 30-year fixed rate conventional mortgage. We've seen a self-employed entrepreneur putting that same 25% down with a 740 score, same interest rate, no catch, same interest rate. So as you can see, the rates on these programs are getting a lot better. And especially on the investment side, sometimes the investment interest rate is better than if you want a conventional loan. So buying with a DSCR mortgage might get you a better rate. Andrew, it probably takes forever, right? This all sounds good. And then you go out and get yourself a contract to buy yourself a house. I don't know where my accent came from. And it takes forever, right? Normally it's a 3-4 week close. And, when you get a non-QM loan, it's 2, 3, 4 months, takes forever, endless paperwork. No, this is all fictitious information. I can't have a conversation with you guys if you think the sky is red and I'm saying the sky is blue. Irrational conversations are not my specialty. What we're saying is objective, it's honest, and it's true. These loans, if done right with the right companies, like a great loan officer at a great broker company that specializes in these loans, is the same turn time or faster than the conventional loan side. All right, the best thing to do right now, guys, hop in the description, click the link. We have a non-QM cheat sheet, gives you all the different types of non-QM mortgages. Now, we're going to talk about each one. I'm going to give a real-life example of someone I've worked with or someone my team has worked with on each of the different loan types. But first, hop in the description, click the link, make sure you download the free guide because to me, I love this stuff. Besides being a girl dad, this is my other superpower. But with that said, it gets a little confusing, and I do this for a living, and I work with thousands of people that are interested in this space. So make sure to hop in the description, click the link, download the free guide. So the first most popular that I've seen, from a rollout perspective, especially, during the pandemic side, the COVID side, right before that, these kind of came out and became very popular, was the DSCR loan. What does DSCR stand for? Debt Service Coverage Ratio. And all it means is if you're buying an investment property, now make sure you understand an investment. What does an investment mean? If you buy a 2-unit investment and move into 1 unit, it is not an investment. So you either are going to, as a primary, move in. A second home is more, on the water or some kind of vacation area. And an investment side, you will not move in. So primary, move in. Second home, usually you could be there up to half the year. Investment, you're not moving in. Now, this is really the biggest type of fraud, which is a very bad word. The only real fraud that I've seen lately or have heard about is people saying they were going to move in and don't, or people saying they're not moving in and they do. So make sure, regardless, this is something you do not do. It's taken very serious. If you say you're not going to move in, you can't move in. So, and I bring that up for the DSCR mortgage, it's an investment. So sometimes it's easy to qualify where it's based on market rent. But if you move in, you're not going to get any rent. So the qualification was wrong. So it is specifically a loan that rolled out for the investment side. Now, investment is a 1, 2, 3, or 4 unit property, a condo. That's been the most popular property type for these DSCR loans. Now, they've opened up a little bit as of late, 5 unit, 8 unit, 12 plus unit properties, some of these big, buildings. They as well allowed these DSCR loans. And all it is they look for a good credit profile, meaning, if you have mortgages, there haven't been any lates as of late. These loans, although they're a little bit exotic or edgy sounding, believe it or not, there's some ways that they're very conservative. You have to have a great credit profile. Your credit scores be in the 600s or higher. nothing in the fives. You have to put down usually at least 20%. Some allow for less. The rate gets a little bit spicy. I wouldn't recommend it. But why it's super cool is you can buy it and have title go into an LLC or a corporation right away. Some people, they say, hey, after I buy a 2 to 4 unit property, my personal name, can I flip title to an LLC? It's a big no-no. You're actually changing the mortgage instrument, and the lender has the opportunity to recall the note. So basically, they can foreclose on you without telling you. So this allows you the opportunity actually to buy it in an LLC or in a corporation. Outside of that, no documents are checked. All they're going to go off of is the appraisal and the market rent. So as an example, just like that property that we were talking about in Miami, a 4-unit property, say it was $1 million property, and the client was putting down 20%. So that's an $800,000 mortgage. Say loosely, guys, a rate of 7%, 7.5% APR. It's a $5,600 mortgage payment. Add in another $1,400 for taxes, insurance, whatever, right? So you're about $7,000 a month-ish. That's what the mortgage would cost all in. Now, a 4-unit property, each unit, the market rent is $2,000. 2,000 times 4, $8,000. $8,000 is greater than or equal to $7,000, so you qualified. It was just that simple. That's how that specific client who was getting a denial from the big bank, they came to us. We did an appraisal. The market rent showed that it was $8,000 all in for the 4 units. The mortgage payment was $7,000. Just like that, they qualified. So the DSCR loan is the first super popular version that came out, and it was very popular. The rate was very in line with conventional mortgages. Kind of went away during the pandemic. Then it came back. There was a very wide gap of the 30-year fixed rate was 7% at the time. A DSCR was at 9.5% or 10%, which is like, ooh, right? Yucky. And now, say the going interest rate 6.5%, you could still get a DSCR to like 6.75%, 7%. So the margin got a lot tighter because the loans are paying on time. It just seems in the secondary market, they're very popular loans, and the clients are actually, in fact, paying their mortgage on time, which everyone loves. The second mortgage, which kind of came out concurrently, was the bank statement program for self-employed. And typically, self-employed clients struggle showing their tax returns and what they're netting, because that net is never enough to qualify for their purchase. So for instance, typically we had the example of a business owner, an entrepreneur. Let's say, for instance, they make $80,000 a month in revenue. So it's about $1 million a year in revenue. But they take a $60,000 salary W-2, and their accountant writes everything else off. So they're only showing taxable income about $60,000 for the year off that W-2 and nothing otherwise on their tax return. It was basically a break even, right? So that $5,000 a month, that wasn't going to do the trick for that client specifically. So we put them into the bank statement program. Now, initially when it first rolled out, same thing, the down payment minimums, which we see now as little as 10%, it's a little bit higher, years ago, 20, 25%, maybe 30% in some scenarios. And the rate wasn't as close, and they usually started with a 24-month review. So you get 24 months of the bank statements, and over the 24 months, you look for volatility. Is the income going down? What's the trends look like? As of late, these are becoming a little more aggressive. Why? Because these clients are actually paying their mortgages on time. So they only ask for 12 months. There are some lenders that ask for 3 months or 6 months or even 1 month. Usually, to get the best pricing, it's 12 months of your bank statements. And in the case of our entrepreneur that we were talking about before, that we saved the day for the business owner, say that $80,000 a month in revenue. Remember? They showed for that $1 million all in for the year in revenue after expenses, a $60,000 yearly W-2, which is $5,000 a month for income, and no other income. They wrote it all off. Now they make $80,000 a month, give or take, for revenue. And because they were 100% owner of that business, the calculation, we literally give them credit for half right away. So whatever your monthly revenue number is, as long as you don't have a lot of NSFs, which are overdrawing your account, which is no bueno, of course, we don't care if you leave $1 in there at the end of the month. Whatever your revenue number is, if you're 100% owner of that business, we give you credit for half that income. So they went from $5,000 a month in income to $40,000, right? On the first example, a conventional loan, we're trying to get a portfolio loan or a jumbo loan. They're going to look at your profit. In the instance of a bank statement program, we look at the revenue and we take half of that for income. So, $5,000 going to $40,000, they 8x'd their qualifications, which has obviously opened up a world of opportunity for the purchase. This was the second most popular, kind of came out at the same time as the DSCR loan. And it's definitely, you can put down as little as 10%, but when you put down 15 or 10% on these, the rate's a little bit higher than if you put down 20%. It may be worth it to put that extra 5 or 10% down. But The bank statement program from a self-employed perspective, whether it's a primary, second home, or even an investment using a bank statement to qualify, not the market rent, has definitely taken the market by storm, and it's evolved, and that might even in fact be the most popular on the non-QM side. A third product that we've seen kind of hit the market and be very popular is asset dissipation or asset utilization, qualifying off of your assets to qualify for a mortgage in of itself. So one option is kind of cool. Say you're getting $1 million mortgage. Say after you close, after closing costs, all that good stuff, you have $1.5 million left in the bank in liquidity and assets. You qualify just like that. They take the amount of mortgages you have, and if you can cover it, making this very simple, you actually qualify. It's asset-based lending. It's something that's become very popular. Now, not everybody has this, high liquidity, but some people do. So they don't have to worry about income. They don't have to worry about anything from a qualification perspective, except for the fact that they have great credit profile and they have enough assets in the bank to overcompensate for the loan amount. That's popular. Another popular mortgage is if you take your all-in assets after you close, after closing costs, and you divide that liquidity by the number 60. Weird number, but that's what they do, which is 5 years, 60 months. So if you have $1.2 million in the bank, after you close, after you pay off the closing costs, divided by 60, that's $20,000 a month. You take that $20,000, that's what you have for income. So if you're buying a house and you're retired, but you have all that liquidity, you can now use, and you don't have to pledge it. It's how they calculate. It's cool. Non-QM has different ways to calculate that monthly income versus conventional loans. They take that $20,000, goes right on your application. If that's good enough to qualify, say your mortgage is $8,000 a month, which is 40% of that $20,000. You would qualify. Of course, more that goes into it, credit score, how they look at your assets. But here, it was another cool addition to the non-QM product suite. When not only did you have to have a certain amount of money left over in the bank, this is another way to qualify, which is, hey, how much assets do you have to your name? And divide that by 60, use that as income, and that oftentimes works as well. Before we get into the next one, guys, just make sure, do me a favor. My team spent so much time on this. Hop in the description, click the link, and get the free guide about non-QM loans. Spent a lot of time putting this together, and it's definitely the cheat sheet you guys need. We have a couple more we're going to go into before. Make sure you got the guide. The next option, which we kind of talked about before, was the 1099 option. So there have been plenty of contractors who have been on the job for multiple years getting a 1099, but typically it was impossible to qualify them. I knew right away, hey, how much you make last year? Well, I made about $250,000. As in the case of our 1099 contractor we talked about before. You W-2 or 1099? 1099. Let's take a look at your tax returns. Do me a favor, that $250 kind of doesn't really mean anything. We need to look at your Schedule C if you're a sole proprietor on what your accountant is writing off as expenses, because that bottom line number we use versus the top revenue number. That $250, they write it down to $60,000. It's $5,000 a month. Might not do the trick, because in their head, they make $20,000 a month. So they're probably thinking $6,000, $7,000, $8,000 for a mortgage. To a lender, they're only making $5,000 a month. So that's a $2,000, $2,500 max payment, assuming great credit and no real debt. So again, in the case of the contractor, the non-QM side, they will use the 1099s of the last 2 years and your year-to-date income. Right? They'll make sure that the trend is similar or going up and not going down. Because of course, if your income's going down, it's concerning. They will use 90% of that 1099, and that's what they use as income. So instead of looking at a tax return, looking at the net, as in the case of our contractor that I worked with making $250, who we thought they were only making about $50, $60 for the year, we went off that $250 amount. They took 10% off the top, which is $25,000, leaves you with $225. And we went off that number divided by 12, which is a little less than $20,000, but it increased our purchasing power exponentially. And that program has become very, very popular for 1099 contractors. Now, the last program, it's something that has become very popular, depending on if the business owner or the entrepreneur is seasonal, is the P&L program. So P&L program is you have the accountant prepare over the last 12 months a profit and loss. It's really one of the easiest documents for them to prepare. All it is on the top is all their revenue. So in the last 12 months, how much revenue did the business generate? It's not the last calendar year, and it's not, are they fiscal or, all that stuff. It's in the last 12 months, year over year, what is the amount of money they made in the last 12 months. Under that are the expenses. The expenses are based off the last 12 months as well. So sometimes in the last 12 months, maybe the expenses weren't all that high. Maybe there's periods of the year where they pay, certain expenses a little bit more than other times of the year. So whatever the expenses were in the last 12 months, you take the revenue minus the expenses, that net profit number, that's what we go off of. And you don't need tax returns. Now, this is good. Typically, if the bank statement program doesn't work, usually bank statement program is a little bit better pricing because maybe their income is seasonal. So I had the honor of working with one of the most popular photographers in the downstate New York area. And this photographer became known for Christmas pictures. And then the Christmas pictures turned into Easter pictures, which turned into Father's Day and Mother's Day pictures. But as you can see, in a 12-month year for self-employed business income, only 4 specific holidays, 4 months if you want to call it, were their high months. Now, of course, Christmas in December, November, and soon October-ish to November to December were the high months for that. March, April for Easter, and then May and June for the rest. So at least 6, if not 7 months of the year, they didn't show a lot of income. So on a bank statement review, the underwriting team will look at that and say, ugh, income's kind of volatile. It's hard to figure out how much you're going to make, and they're not going to give them credit for anything. On a P&L, we don't see the bank statements. We see in the last 12 months how much money they made all in aggregate for the last 12 months and their expenses. And that was the best program for this type of clientele because we first, of course, tried the bank statement program. And the bank statement program, they were making, for the full year, they were making millions. But they got credit for nothing because it was volatile. But on the P&L program, we had, call it $2 million a year in revenue, and there was a little over $1 million in expenses. So we gave them credit for about $70,000, $80,000 a month of income. It was a home run program for them, but this did not exist until recently. These P&L programs have come out recently. These aren't things that came out initially. Initially, it was the DSCR and the bank statement program. And as these loans have been in the market and clients are paying them on time, and lenders and investors are finding more ways and more guideline tweaks to ensure clients qualify for them at a greater extent as these non-QM loans are performing, meaning the clients are actually paying them on time every month, no 30, 60, or 90-day lates. Programs like these P&L programs are being invented because they want to increase the product offering to self-employed clients. Turns out, based on the credit profiles these look for, which is like high 600 to 700 credit score range and above, the down payments, which are really typically 20% down or more, and then the post-closing liquidity, meaning how much money you have left in the bank for a rainy day, because these items are so attractive for these borrowers and lenders, these companies that are offering these non-QM loans that we as brokers, as the middle person, kind of facilitate for the client. They're more and more are coming to market because self-employed clients do make a lot of money. Just because a conventional mortgage, the way they look at what you make is off of your IRS tax return, just your net profit as a corporation owner or a sole proprietor. These end lenders are seeing if you put 20% down with great credit scores, you got a 30-year fixed rate mortgage, and you have a lot of money left in the bank, the likelihood of you paying is almost at 100%. All right, guys, so now that you know about all the major non-QM loans, now how do you actually qualify? What's the math behind it? So make sure, guys, you click the link and watch our next video, non-QM loans, the math behind them. Bank statement loans, DSCR loans, P&L loans. How do you qualify? I'm going to go into all the different loan types. Make sure you click the link and watch this video, guys, and show you how do you qualify, what's the math behind it, what underwriters look for. Click the link, check it out.